All right, guys, so now you know what DSO is. So now here's the burning question, right? Here's the golden question. What is a good DSO number? What is the standard DSO number that I should be shooting for? I'm just going to summarize this whole video for you so you know the truth. Look, there is no golden number. DSO does not have a uniform number. It's not a KPI that you could blanket across multiple industries and multiple companies. You just can't do it. Generally speaking, I've seen a lot of industries that use 45 days as kind of their golden goose, 45 days being like kind of the golden number they're trying to get below. 45 days seems, pretty good. It's not necessarily, it's only 15 days past due, so on and so forth, right? Here's the deal. DSO is really, really designed to allow a company to measure itself, right? Meaning you want to use your DSO numbers to measure what were your old DSO numbers? If you make a tweak over here, did it change your collectability of accounts over here? That's really what DSO is for. It's not really designed to compare companies or compare industries. In fact, if you were to take a DSO number from one business and then you walked into another business and you tried to go, well, company A's DSO is this and it's in a similar industry, so company B's DSO should also be this. It's never going to really give you the right number. Now, you might get lucky and it might give you some compared numbers. Maybe a lot of the variables are the same, but DSO has a lot to it, and there's a lot of variables that account for DSO. So when you start taking that measurement metrics and you take it out of the business itself, and then you start trying to use it as a comparison for other businesses or other businesses, even worse, other businesses in other industries, your numbers really start to get skewed. Like, I'll give you an example. Let's just say one company hardly extends credit at all, and the other company extends credit all the time, right? So your first company is very tight on credit policy, and your other company is very loose on credit policy. Well, the company that's very loose on credit policy, the company that's extending a lot of credit terms and maybe has a different credit policy or a different credit demographic, is going to generally have a higher DSO number. Where the company that's hardly extending credit is, of course, going to have a lower DSO number. If the company is only extending credit to companies that they've done business with for over 30 years that generally don't go past 7 days outstanding, well, of course, their DSO numbers are going to be low because their risk level is low. They're not taking a lot of risk, so of course, it's going to make the numbers lower. Or so let's talk about like even a client's client base, right? A company's client base. So even a company's client base is a variable that could skew the number. So let's just say you have two concrete supply companies and they sell to subcontractors. Let's just say one deals with large subcontractors and the other one deals with medium to small subcontractors. Well, even though you're selling the same product and you're in a similar industry, the client base and the risk level of the client base is different. So the receivables or the day sales outstanding is probably going to be higher or lower depending on what those variables mean. So the big companies, the guy that does business with all the large companies, maybe his DSO is higher because it's harder to process invoices with the larger company. And maybe the ones that are smaller or mid-sized companies, their DSO is lower because the small and mid-sized guys are trying to pay their invoices as quickly as possible. Or maybe the small and mid-sized guys pay later because they don't have the cash flow, and maybe the large guys pay faster. But that gives you an example of how that kind of plays into factor and why those numbers would be skewed and why you couldn't say, well, the DSO for this industry is this as a flatline number. Don't even let me get started on industry differentials. I mean, the worst thing you can do is go, okay, well, DSO number on this business in this industry is this, so that means DSO number on this business in this industry should be this. No way you're going to get anything similar. Now, maybe the moon and the stars align and there are some variables that are about the same that kind of make it similar. But the reality of the situation is DSO is all about the variables. It's all about the variables. So just to sum this up, listen, DSO is a fantastic tool to measure your business against itself. So if you're doing one thing or the other with your company and you're trying to see how it affects your accounts receivables, DSO is a very good way to look at what your DSO used to be, what it is now, and what you're shooting for in the future. It should be met. It should just simply be a KPI that's used against the business itself.